Okay, yeah. Hi everyone. Yep, super excited to have you all today here, and thank you so much for joining in, and welcome to another Lead Squared webinar. So today we are here to discuss how we can rethink customer borrower journeys in 2025, and what exactly lending institutions must do to unify processes from loan applications to collections. So, without further ado, let me just quickly introduce the speakers that we have today. And first, the speaker for the day would be Vineet Sharma, who's the Director of Business Development, handling the BFSI vertical here at Leeds. Vineet brings in over a decade of experience in helping organizations navigate through complex business problems. So, in his current role at Lead Squared, he focuses on delivering digital transformative solutions tailored to large enterprises across the BFSI space. Welcome, Vineet.
Thanks, Abhinav. Happy to be here.
So our next speaker would be Dev Surti, who's the group product manager. He is also a product expert in the lending vertical at Lead Square. So Dev is leading a product in lending vertical at Lead Square, and like with a deep focus on efficiency and automation. So he works towards making digital lending faster, smarter, and connected by developing solutions like loan origination system. So before I go off stage, stay with us till the end for an insightful session. So drop your questions if you have any in chat, and over to you, Vineet.
Thanks, Abhinav.
Thanks, Abhinav, and I welcome Dev to this session, which I am very much looking forward to. And Abhinav, thanks for setting this up, setting the context, and welcome to the wonderful audience that we have here. Dev, how do you feel today?
Good, Vineet. How are you?
All good. Dev, I think we have a very interesting conversation coming forward. As our audience already know, today we are going to talk about how a unified experience in the lending space can really transform conversations, can help a better experience on the customer side as well, an experience of selling for the sales team in the NBFC and banking across lending domain. Now, they many
Right.
a times, if it is coming to a discussion on the table, and I can speak from my experience of working with NBFCs across different sectors and product lines in the last 3 years, that uh, nowadays with the advancement of the API universe, the expectation of customers have gone drastically high. Now, from a system of transactions, the world has evolved to a system of engagement. Yeah, this is across the board, right? Then
Correct.
the advancement of CRM platforms, and data always in real time. All of that is happening now. This is also increasing the expectation of the customer, and there is a great deal of instant gratification. And now we see that across personal loan. But I think similar expectations are there with the customers when they want to avail a four-wheeler loan. Why do they want to wait a lot when there is every information available across an API? So the first question is, how do the traditional LOS system would limit a lender's ability to deliver real time? And I also want you to speak from a perspective of, there are companies, or there are some large organizations which still remain on a legacy stack.
Right.
What is your thought? Uh, how if we sit and analyze this well, how much of a real limit a traditional LOS can put on this ability of instant gratification and lending?
Yeah. So a great question to start with, Vineet. You rightly said customer expectations are changing and changing very rapidly. Instant gratification is now not only in terms of retail but also in lending. Personal loan, this revolution had started, I would say, uh, a year or 2 years back, where lenders started giving personal loans in 5 minutes or under 5 minutes, or in sometimes uh, even in less than a minute, right? So this is now even expanded into other segments. In a way, if we look historically, the focus in the lending has been on delivering real time products, right? So lenders always want to deliver real time and personalized experiences to the customers. In a way, till now, lenders have been doing some bit of that. Okay, so if you look at the systems today or the experiences today, those are mostly derived from segmenting the customer, profiling the customer, and then providing them with an offer. Okay, which is a traditional pre-approved offer that we see. Um, and this is all rule based. Okay, so uh, rule based decisioning, creating customer cohorts is something that the lending world has been doing since some time now.
Yeah.
And this is where the traditional LOSs limit themselves. So now the world has moved towards, or the market is moving more towards hyper personalization. So it is not just personalized experience, but hyper personalized experience. So how is it different from personalized experience? A personalized experience is a rule based decision, where I say that, hey, Dave has a credit score of more than 750, okay, and does not have any derogatory data in the bureau in last 2 years. Let's give him a pre-approved offer. Okay, so this is rule based. Now the movement, the shift in the market that we are seeing after numerous conversations with customers is that lenders are now wanting to take context aware decisioning, right? So we can think of this like the lender wants to be aware of the context in which the loan is being given or in which the experience is being created. So imagine something like this, where say there is a customer who is spending a lot on car servicing, and the fuel spends of that particular customer are increasing. Now all this transactional data is available today. What is lacking in a traditional LOS or a traditional point applications that we have seen is the inability to cross reference this data. So can I in real time cross reference the data between the systems, cross reference the transactional data with the bureau data, with the bureau history, and then generate an offer for the customer, which can be pre-approved, can be given as an in principle approval, but it is in the context of what the customer is facing today, and hence the chances that the customer would take that increases manifold, right? So this is the first difference, right? So lenders are moving from rule based decisioning to context aware decisioning. Second big shift we are seeing is towards predictive intelligence. So if you look at, again, historically lenders have been segmenting their customers basis cohorts, right? So I have a entire group of customer. I will divide them into different cohorts basis their age, and basis their where they are staying, basis their income, right? So these are different cohorts that lenders have traditionally been creating, and then historical patterns used to be created, right? Now there is a shift in that. So now lenders want to be predictive in nature, right? So it is something like, if I had to give an example, a person who is, say, taking a personal loan today, and the purpose of the personal loan is wedding expense, will mostly require a home loan in 2 years, right?
Yeah.
So
That's the context that you're talking about. I get it.
right, so this is
Yeah.
moving towards predictive intelligence. So
Yeah.
creating that intelligence not just by cohort based segmentations, but going further deeper into segmentation, and then identifying what the customer will do, what would be the future need of the customer. So this is where the personalized experience differ from the hyper personalized experience, and a traditional LOS can never deliver this, right? So it is like the technology, the inability to connect with multiple systems, to get data from multiple sources, seamlessly integrate at scale, right, and then engage the customer throughout the lending life cycle is something which we have seen traditional LOSs limit the lenders a lot.
Very interesting. I think you've spoken about a very interesting word, which is context in lending, right? So that brings me to another thing. Let's zoom out from a product and go back to the industry. What would you suggest that in today's world, where there are NBFCs emerging as digital first NBFCs, and where a view of what kind of cost in the sourcing of a loan and what kind of marketing we should do, what kind of customers we should acquire. With that, you've also spoken of context. Brings me to the next topic. Let's talk about how should an NBFC integrate their marketing efforts, which run smoothly with sales, sometimes land directly in the ops and credit function. And I mean, that's an extension to the question number one as well, that we have not seen too many great examples of that in the industry, where the marketing is also integrated with a complete objective of lending to the customers. So what do you have to say? What could be one or two strategies that the NBFCs can do in this regard?
Yeah, and uh, this is really more of a question of how because of all the fragmentation, how different data silos have emerged, right, over a period of time.
Yeah,
So
yeah,
if you look at this problem, so right, so how can a lender integrate between marketing, sales, credit, operations, and give a world class customer experience, right? So if you look at this problem, uh, and again this is derived from our experience while talking to customers about CRM, while talking to customers about LOS, and then stitching the story together and understanding that what problems lenders are facing today, right? So uh, in a way you can say that this particular problem has three parts to it. The first one is around data, right? So there are data silos today. The data is fragmented. So the data for a customer profile resides in CRM, data for say risk assessment in some other system,
yeah.
and the engagement history might be in some other system, behavioral data in some other system. So what happens is, because of the fragmented data, it becomes extremely difficult to build a 360 view of the customer. And
Yeah.
without the 360 view, and lender is never able to completely provide that real time experience to the customer. That's the first part of the problem. Second is right. So without the 360, we can say the experience gets broken. If you look at the journey, right, so right from the generation of the lead to the sales cycle, which we call the onboarding of the customer, then the underwriting, right, and then it moves into servicing and then the delinquency journey. So if you look at this, so let's stay on the sales part. What happens
Mhm.
is, today the experience of the customer is broken, and the customer drops off. There is no way for the customer to in an efficient manner get back. And this is true for not only for large banks, but we have seen this issue, or even large NBFCs, mid-size NBFCs struggle with providing a very unified experience. Uh, and the third part of the problem is around prioritization. So without with all these different silos created, what happens is the sales teams and the underwriting teams are never able to prioritize their leads in a very efficient manner, right? Because the sales part of the sales would function in lead management, part of the sales would function in an LOS. The context between the two systems is lost, and they are never able to prioritize, right? So if with this three part problem. So all these the different strategies can be deployed by an NBFC to ensure that the data across all these different functions is unified, and with the data in place, then they can create a 360. They can unify the experiences, have better prioritizations, right?
No, I think
So
we you've also spoken about the data in silos. You began answering this question with data in silos. That is never helpful, and I think if I'm understanding it correctly, uh, a marketing campaign brings a certain cohorts of the customer or certain type of the customers with certain attributes and demography, which speaks of a different propensity of conversion. And when it goes to your application and underwriting module, that speaks a different story. And if all of this is not in silos and in the same system, maybe there is
correct.
a better learning curve for an NBFC to understand what kind of demographics end up in what kind of propensity of underwriting. And the next set of marketing campaigns can follow the same suit. And the
Correct.
product evolution on the NBFC side can also improve. So I think a lot of advantages when we are talking about it. There's a lot of things coming to my mind.
Yeah, so say extending to this, right? So we talked about there being the customer engagement data siloed in a lead management or customer engagement or a CRM platform, a CRM system, and then the underwriting data somewhere else. So imagine this. So when you want to prioritize a loan, okay, today the prioritization also happens in silos. So when you are doing prioritization in LOS, you look at some part of the customer profile, some of the underwriting data, maybe the score of the credit score, the risk category of the customer, and then create a view.
Yeah.
Majority of the engagement data is not factored in over here. And historically, if you have to, so one of the systems where one of the capabilities where we are also working very actively is can we score a lead or a loan by looking at the historical patterns across different micro segments, and
Yeah.
then use AI. So using AI, we identify these patterns and then define a conversion probability for every loan. So now the data for the engagement, historical data for those kind of micro segments would come from the customer engagement part of the journey. Okay, where you want to analyze how a customer progressed, when the customer gave data, and if the customer gave certain type of data, then the chances of conversion increases, and hence the underwriter should pick those loans before other loans. So right, so this is how you can build prioritization using data from different systems.
I think very interesting. I think what you're saying is, I'm sure audience would have loved the argument that why not use the data that you've gathered over a period of time and try to create a model out of it, put deploy it back into the marketing, and then the credit team prioritizing it because obviously it is coming from the same uh, 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 history of credit underwriting. Very interesting. Uh, Dave, another question coming in. Now we started by understanding that how a legacy product can limit the landing capability. The next question was that because we were dwelling on this topic, that how an integrated marketing along with the other functions can enhance overall underwriting and customer experience. Now, uh, do do you see an active role? It's the third question. Do you see an active role of an LOS system in its ability to add more channels? Because many a times it's part of marketing and business strategy that when you add more channels, it is not really linked to an LOS. Rather, the other way around. The channels are pillars standing on top of the LOS. What is your view on this?
Okay, so I think this is so again a lot of limits that we have seen traditional or lenders struggle with their traditional stack. when they want to deploy new channel, new strategies. Okay, so today there is a lot of movement towards lending to tier 2, tier 3 cities, right? Uh, and one constant pain area that we hear from NBFCs is that we want to expand, increase our reach into the tier 2, tier 3 cities, and but to do that today we don't know. So strategically the NBFC would know, right, what route they want to take, whether they want to go organic or they want to go in a co-lending model, right, to increase their reach. So strategically an NBFC would know, but from a technology perspective, okay, how can they really do this is a big struggle. Recently, I was conversing with an NBFC who wanted to expand into tier 3 cities, but the problem that they were facing was more towards, so it was not about increasing the how to increase the reach, but it was about how can my tech stack enable in targeting specific customer segments, okay, in those tier 3 cities. So if we look at this problem, so we need to understand what's different about tier 2, tier 3 cities, right? So when we talk about deepening the reach, how does a tier 2, tier 3 city is different, and how to increase the customer reach. So there are around three or four main differences that we have seen. First is in a tier 2 or a tier 3 setting, the new to credit customer would be higher, but we have seen in our conversations with lenders that lenders identify many such NTC customers as digitally savvy. Okay, so
Yeah.
these customers have become so adapt to lightweight applications with simpler with applications providing very simple interfaces like WhatsApp. Okay, so in a way, someone cannot say that they are not digitally savvy. They are digitally savvy. They have a smartphone. They know how to use applications, and tell their needs, right? The, this is the first difference from an urban city. Second is there are a lot of self-employed customers, okay, in tier 2, tier 3 cities who may struggle to get formal financing, and this opens up a big gamut for the NBFCs, especially who want to do simpler secured products like loan against property. Okay, um, and the third aspect is in terms of differences is the regional language usage, right? So
Okay.
if you look at these differences, a tech platform, how can NBFCs leverage tech to uh, address to these differences in the tier 2, tier 3 cities? Okay, so in a way, talking about the digital savvy customer, okay, which we are saying is digital savvy to the limit of say using an application like WhatsApp. So the lender can deploy in order to increase their reach. They can one of the strategies that they can use a WhatsApp based chatbot, right, which via which they can help the customer. So understanding the need of the customer, they can enable the customers to apply for a loan, to upload documents, to check their eligibility, right? So a whole service gamut opens up when you talk about WhatsApp as a channel which can be used in expanding the reach. Second
But
area.
wait, let me pause you for a minute. When we talk about a WhatsApp bot-based lending, I think many NBFCs are leveraging this. I
Hmm.
think if we have to pin down the question and go into the next layer of detail, uh, take a scenario that an NBFC which started with a motto of lending 100% of the loans on its books. Now all of a sudden the strategy changes in the boardroom that maybe they want to do co-lending.
Hmm.
Now the stack that they had built 3 years back, would it become a point of contention when they want to execute this strategy? And how does a new age lightweight configurable platform lets them execute the strategy that they discuss in the boardroom without thinking about the tech stack?
Right. So Vinit, it is interesting. So when we look at these strategies, they never work in silos, right?
Yeah.
So a lender, when they are taking decisions, would never say that, okay, one strategy works but other strategy does not. Okay, so
Mhm.
it has to be a mix of strategies. So we have seen lenders, demanding multiple kind of solutions, targeted towards multiple approaches, right? So if, say, one of the approach is a DIY journey, or a chatbot kind of a solution, the tech stack should be able to enable that channel for the select group of customers, right? So it's important that we understand the type of customer you want to cater to, and then give the right solution or the right channel to that particular customer. And second is another strategy where we say that, okay, we will grow organically, but we will also grow via the co-lending route, is where integrations come into picture. Over there, their tech stack has to, while it is also enabling them to do chatbot based lending, customer segmentation, that system, that LOS also has to enable them to seamlessly integrate with different partners, seamlessly execute the credit policies in real time for different partners, and give a holistic strategy, right? I mean, execute the strategy holistically.
Since we are on the topic, I'll request the audience to participate in the poll specifically to this question. And the question is, when expanding into tier 2 and tier 3 markets, what do you think are the most effective strategies? You can see the poll in the chat box. I request everybody to share their perspective. They're very interesting. I think the next question that I have is something similar, because we're talking about channels. Now, traditionally, we have seen that there is no all strategies getting executed by the organizations. Some are very strong on the manpower. They say that I don't want to be dependent on sourcing on the third parties. I would want to source my own loans. Some come with the thinking of I don't want to invest in manpower. We want to be DIY first. This extreme nature. What do you think? Is it because of the tech stack? Because you mentioned it, that whenever strategies are being built, they are never built in silos. They are cognizance of the tech stack and ability. So either you are DIY first, or you want to source everything on your own. Does it come from a limitation of the tech stack, or this is in general the strategy of the organization? Or do you think if I start, or if an NBFC start from thought A to converge to a thought B, again LOS becomes a hindrance? What's your thought on that?
So uh, we spoke about some part of the strategy in our previous
Yes,
question, right?
yes.
Uh, it has to be a mix of strategy, right? So uh, the the issue, I don't think the issue is of only an org strategy or a vision, or it is their tech stack limiting them to play in both. It is sort of, you can say, a mix of both, right? So what happens is, and this is where, till now we have been seeing things move in personal loan, for personal loan category, but now we are also seeing the shift in also in secured loans, especially secured lab, secured loan against property, or say in smaller tier markets, in two-wheeler loans, right, three-wheeler loans. We are seeing a lot of shift. So one important thing to understand is that if you adopt a high DIY strategy, okay, then definitely there will be high customer drop-offs. Okay, but if you adopt a high assisted strategy, you will end up having a lot of operational cost, right?
Yeah.
So this itself answers the question that it has to be a balance between both the things. And in a way, lenders have to, when they're balancing, it's important to understand that not every customer, so every customer is different, okay, in a way. And that is where we spoke about micro segmentation, and identifying the contextual need of the customer. Now, some customers would be digitally savvy in a region, okay, whereas another type of customer, another micro segment of customer would not be digitally savvy. Okay. So what happens is some customers require are easily able to navigate through a DIY journey, whereas some customers would definitely need assistance. What's important is that with the balance coming into picture, what's important is that there has to be a very seamless handover or a very seamless transition between DIY and assisted journey. And this is where most of the lenders today we have seen if they are not able to do a good job at it. And the reason for this is their limiting tech stack. Okay. So so now it's really important that, okay, if I have a customer who is digitally savvy doing the journey on, say, a website, or a landing page, right, just providing me some amount of data, or say WhatsApp, right, that customer could face an issue at any time, right? And every customer is different. So some
Yeah.
customer would face an issue, and hence they would look for assistance. So it's really important for lenders to identify the drop of signals, and we work with a lot of lenders to define how a customer drops off, and then what strategy should be applied when a customer drops off. So we call this drop of signals,
Yeah.
and it's important to define the drop of signals. Okay. And this has to be done in a platform which combines both CRM and LOS, right, providing a full view. So with those drop of signals in place, the lender will be able to easily switch a customer from a DIY journey to a assisted journey. So say, for example, think of say a loan discovery process, right? So a customer is trying to understand the product recommendation or say product offering via WhatsApp at the channel, and then the customer drops off, or the customer is typing something else in the chatbot, okay, which in a way raising a query which the chatbot does not understand. How can your system or tech stack immediately create or say transfer that to a human agent who is able to guide the customer in the discovery process, right? And similar kind of drop off signals are available across different stages, right, from discovery to application starting to the point where customer is doing KYC, right? So this is
Yeah.
how a lender will have to think and create the drop of signals and create strategies around how to navigate the customer, right? So
So it's
balancing
making
is the key.
it's making me think that if we look about customer management, that's the USP of CRMs, right? And if it comes to the ops and application login underwriting, that's a function of LOS. So I think answer somewhere lies in the third question that we spoke about. How should the marketing run hand in hand? And the answer lies, from a legacy system to platformification of the entire lending tech stack. I think that solves for the problem. So I think to summarize, we talked about audience. We were talking about the question whether some NBFCs are only DIY first, some are only they do a complete FOS based sourcing and landing. Is it the tech that is a problem? I think they've answered it very well by saying that the decision is more about the strategy in the beginning. That's how the organizations start. But in between, the limitation of the tech stack kind of becomes a roadblock when customers or NBFCs want to experiment in that strategy. But obviously technology has answered to all the problems. That cannot be a limit. Great, Dave. I think I would like to move to the next question that we have. And audience, I will encourage you to please post your questions. We would want to take them up in the last 15 minutes. Dave, one interesting question that anybody would ask after what we have discussed, that uh, in when it comes to creating a tech stack for any organization, there is one thought that you pick up the best in point solution and do an integration. In today's world, integration is not a problem. Everybody is on API framework, right? So best in class point solutions stitched via an integration layer, That compared to a unified platform, what are the trade-offs in the two?
Okay.
Yeah.
I think the traditionally that has been the approach, right? So traditionally the approach has been get the best of the breed point solutions and just plug that in and let's start working. Okay. Now, so one of the biggest risk, and that is eventually where we see a lot of lenders struggle as well today, is the silos that gets created inherently. Okay, so you say there could be multiple reasons why a lender would have chosen to go with best of the breed applications. It could be, say, they want to go to market fast, they want to launch their product fast. There was no time of thinking about, say, a collections when you really want to grow your business, right? And hence you say that, okay, let's just have an LOS today. Let's look at the best out there in the market, and let's ignore the rest of the things for now. So this is how we have seen in a long run, it impacts the overall health of the portfolio. So, we spoke about data silos, that you don't get a unified view of the customer. Okay.
Yes.
But this is on the selling side. Thinking, so one of the statements that we keep on hearing from CTOs is that LOS is a silent contributor to delinquencies. And if you think about it, what happens is, and LOS today, when they are when a underwriting team or say a system is taking a decision on the LOS, they are mostly relying on the data today. Okay, maybe they would be looking at the bureau data, the banking data, right, the demographic data, but without the unification, okay, they would never, they are not considering the dynamic borrower behavior. uh, so the borrower behavior, which is changing every day, uh, how can, say, a data in a collections or a loan management system, how can there be a feedback loop into the LOS, such that the underwriter who is right now appraising or assessing a particular loan, how can they get insight into this data and then take decision basis that, right? So this is one area where we are seeing a lot of movement, lenders realizing now that there is increase in the NPAs. So we are seeing a lot of movement in this area where lenders now wants to move towards a platform, a unified platform, right? And reduce this particular risk, right? So the clear trade-off, to answer your question, Vineet, is that if you want to go fast to the market and just deploy a point application, then in long term, I would say 2 years from now, that lender will not be getting a unified view of the customer. Though integration between two systems can be done, but it is not so easy, right? You will end up deploying data lakes, segregating that data, slicing and dicing, and uh, getting that data back into the system, the underwriting system, to take decisions in real time is really difficult, right? So this is where lenders, we are seeing a shift towards a unified lending platform.
Understood. I think you're right, and this is not just true for the lending space, but I think uh, data warehouses, they basically ingest data from many places, and they give you a view of the data which helps you formulate strategy, but it never lets you do anything live in action, right? For that you need to have a stack that in real time that is natively connected. So that will obviously come from a one unified platform. uh, as long as it is beating the best in breed point solutions 60-70% in each of the areas. I think that then the decisioning by the CTOs will swing into favor of one platform solving all, where maybe they are not the number one, but maybe number two in each of the functions, and maybe
Yeah.
number one in one or two. So I think that's a good articulation at your end. Uh, so they, because you also handle the portfolio of the product management in Lead Squad for BFSI. So I'm sure the audience would also want to understand that what are the best features or capabilities Lead Squad is developing when it comes to the lending platform. What are the two, three things that you can talk about? How would you describe the future of Lead Squad lending um, uh, ecosystem? And audience, by the way, I would encourage all of you to go to our website and see the lending cloud of Lead Squad, so that you can relate to what Dave is going to answer to this question. Dave, back to you.
Yeah. So I'll talk about three areas, Vineet, where we are doing a lot of work, where we are trying to solve a lot of pain points across different functions in a lending organization. So the first is bringing in customer engagement as part of the complete lending life cycle. Okay, so till now, so as we already spoke, right? So it's important that you have to engage the customer not just while lead generation, but also till the point the customer's loan is disbursed in a lending sales life cycle. So this is one area where we are doing a lot of work, ensure bringing in customer engagement at every step in the lending life cycle. So over here we are basically increasing the exposure to different channels for the lenders. So unification is an area over here, right? So how can you enable your customer to start the journey via WhatsApp, but then switch into an assisted mode wherever the customer is facing a problem, right? Or say whenever the customer is going through an assisted route, uh, for certain actions where you want to improve the efficiency of your teams, not give those tasks to your FOS, to a feet on street to talk to the customer and waste their time, but rather so they can focus on the sales, but the LOS should be able to engage with the customer in real time on those things. Say something like data collection or document uploads, enabling the customer to e-sign their loan agreements seamlessly without FOS involvement, right? These are some of the things, right? So our focus is very much on bringing in customer engagement. The second area where we have done great work is bringing configurability into play. So a lot of traditional LOSs, and this is where we see a lot of struggle that lenders faces, is how can we go to market faster, and subsequently after we go to market, how can we reduce the change management time and cost. So our answer to that has been configurability. We are our platform, overall platform, not just CRM, but LOS and collections are completely configurable, right, to the point where we have customers whose IT team manage the entire application on their own, right? So they are able to make changes to the system in real time. There are a lot of regulatory changes that come in. There are a lot of policy changes that they do. So we provide the ability for the users to configure the system and change the system in a no-code manner very efficiently, right? So our customers, they see a massive reduction in the total cost of ownership, massive reduction in the time to market with the configurable platform. The third area I would like to highlight is AI. So we have been doing a lot of research into it, and this year this is one of our focus areas. So bringing AI across the lending lifecycle, right? So addressing use cases. So the AI over here gets applied during customer engagement, um, during the underwriting process, and during collections as well. So So to give you an example, we are working on a AI based prioritization engine, right? Which will look at all the data that is there in the platform, and then understand uh, how the customers are moving across the sales cycle of a lending, right from lead generation to disbursal, and what actions are they doing, and what stage are they, how are they moving across different stages to understand, to assign a score to the customer and prioritize the customer basis that. So in a way, we are calling it supercharging your prioritization. This is
Okay.
one area. Second area in AI is somewhere in reducing the manual data entry, right? So uh, how can we enable the underwriting teams in efficiently capturing the income assessment data? Can they just click photos, and we read through the photos, convert those images to text, and then recognize what is the, say, whether it's a shop, if it's a shop, what is the name of the shop, what is the GST, right? So things like this. And third is AI agents that would help in processing the documents faster, right? So doing reading data from structured and unstructured documents to fill up the loan applications in a fast track manner. This really, we have seen this really come into picture across different channels, right? So these are some of the areas we are actively working towards.
Thank God you spoke about AI, because after the first two questions, audience was getting impatient that how come the product head is not talking about it. So, on the lighter side, of course, today any roadmap of any software product is absolutely incomplete without AI. But I think there is a lot of discussion on that in about. So I attend many conferences as well on banking and insurance, and everybody talks about how can leverage the technology with being in the influence or in the regulated environment of IRDI and RBI. And I think those are the things that everybody is talking about. We have not seen too many use cases running successfully across the various industry subsectors. And I think in the next 1 year, it is going to be implement trial and error, and a lot of experimentation using AI. But I'm sure, like you spoke about the underwriting, I think that has clearly a few use cases that how can underwriting process or customer experience be better. Thanks for answering this, Dev. And I think that brings us towards the end of this webinar. But we have a couple of questions from the audience. Let me pick up a few, and I will encourage the audience to keep putting down the questions in the chat box. And the first one, the first question is yes, pretty much of what we spoke just now. Increasing government regulations are hurdle in compliances, and every quarter there is a new regulation.
Right.
How can NBFCs use technology to use compliance at all times? Okay, very interesting. So how can NBFCs use technology to ensure compliance with the new regulations coming from the regulatory bodies? So yeah, they not directly to the lending space, but I think maybe you would have some perspective to this question.
Yes, Vinit. So this brings us so on the point of uh, I mean, I would answer this question from the context of configurability. So I mean, yes, the question points out a real challenge. There are a lot of regulatory changes that keep on happening. Talk about the regulation around the KYC updates that came some time back, right? Where you have to say so basically, this is the risk category. You have to update the KYC information to do the re KYC. There are a lot of changes happening in terms of how the data needs to be fed to CKYC registry. So And obviously, I mean, so risk monitoring is something we all know RBI is super focused on. So we have seen over here lenders struggle in terms of enabling the technology or making the changes in a solution to achieve these changes faster, right? So this is where the real struggle we have seen, where say tomorrow, if say there is a new KYC norm coming in, say tomorrow, we already have an indication from RBI that video KYC will become a primary source of KYC in some time, right? So how can a lender today who is say on a old stack or say doing KYC in a physical manner, how quickly can they move to enabling video KYC in their journey, right? So it is about making changes to the system in a fast manner, uh, addressing basically the regulation not just from the point of view of the intent of regulation, but actually enabling your users to not face problem because of that, right? So switching between say if I take example I took example of video KYC. So how can we enable integration with the video KYC solution in less than 2 or 3 days, and help the users in on the training part, and they can quickly start adopting the solution. If say there is a change in the KYC norm, how quickly can we enable that change in a no code manner without going back to the code, changing the code, redeploying the code, right, and creating a new version of the system, right? So it is a mess we have seen across the lenders. So this is one way. Second is, see, we spoke about AI. This is one area where Gen AI can be leveraged a lot in understanding the regulatory landscape in real time. So enabling your credit users through underwriting users and operations users through these regulations becomes really important. So one way to look at it is from the tech side, where system configurability plays a major role. Second is enabling your teams, right? So generative AI can be used there a lot to easily pass through the regulatory landscape in a periodic manner, suggest changes to the underwriters that they can make to the credit policies, uh, and redeploy those policies, backtest those changes on the existing portfolio, right, to achieve the best result in while completely staying regulatory compliant, right? So this is what I think. It is not just configuration, but rather also knowledge, and then putting it back into the policy changes at a lender side.
Thanks for answering that, Dave. I think in the positive time, there are a couple of more questions, but let's take one that Himanshu just posted in the chat box. Himanshu asks, what are the compliance implication of channels like WhatsApp for NBFCs and data privacy rules, etc.? So while we all know WhatsApp, uh, we don't have a straight uh, rules applicable for this channel, but Dave, what is your view on this? Suppose if you can take a few examples and maybe then expand on that.
Yeah, so I mean, a lot of this, to be honest, is in gray today, right? So uh, I think regulatory agencies are also learning. As we speak, as the innovation is happening, they are also learning in terms of implications, right? So from a privacy perspective, if you see, a WhatsApp channel works in a very similar way to a portal channel, okay, or a website. You are taking the data from the customer and then processing the data in real time to generate offer, to give recommendations to the customer. So it is important that the platform you are using, that the platform the lender is using is has the has all the right controls put in there for data security. That is the first key thing. Uh, because just like a website journey, right, when the customer enters data, that data will be processed. Different sources will be called, and that there will be a lot of in transit movement and calls and data fetch happening. So we have not seen any specific compliance implications which are separate to a channel like WhatsApp.
Just to give you an example, I was speaking to a customer in lending space, and the discussion came in that because of the regulations from TRI and RBI, you cannot call the customers who have
Hmm.
set up their numbers for do not call, but
Hmm.
it doesn't stop them from sending a WhatsApp. So maybe I think the true answer is gray. I think regulatory bodies will also take cognizance of they need to have instructions roll out for channels like WhatsApp as well. Time to see that how WhatsApp or Meta they will follow the rule of following the
And
regulations by yeah.
right. So, I mean, to add, we have seen a lot of lenders see risk in enabling their sales users in directly communicating with the customer on WhatsApp. This happens a lot today in the market, right? So, a sales user can ask documents from the customer. Today, also they are asking documents from the customer on WhatsApp, right? And customers till now have been sharing, but in certain segments, in certain loan products, we are we have recently conversed with a few lenders who are saying that our customers are now not trusting unless a WhatsApp message comes from a business number or
Yeah.
from a verified number, right? So it is a channel that lenders have to use in the right manner, by ensuring that the trust on that brand is not deteriorated, and hence deploying the chatbot journeys with platforms who are secured, or have great controls on the security side is really important.
Great, thanks for attempting to answer this question. While it is a gray area for sure. Audience, I we are nearing the end of this session. I hope at least I enjoyed this conversation thoroughly. Thanks for being with us, and I would encourage everyone to just go to the chat box, access the link that I'm just putting now, which is basically about the landing cloud of Lead Squared and where does it and how does it benefit industry leaders like you. Thanks for joining us. I'm handing it over to Abhinav as we are nearing the end of the session.
Yeah, and thank you so much, Vineet, and thank you so much, Dave, for those insights. And that wraps up our discussion for today. And once again, thank you so much, guys, for joining in the session and sharing your insights and giving your time out. And also, of course, to everyone in the audience for joining us. Thank you so much, guys. And we hope you found this session valuable, and we look forward to seeing you soon again. So yeah, thank you, guys, and yeah,
Thank you.
have a
Thank you,
great day.
everyone. Thanks, Dave. Thanks, Abhinav. All right. Bye.